The catch-22 in starting a growth company is that on the one hand, you need investor funding to feed growth. But on the other hand, at the beginning, you haven't made enough headway, haven't gotten enough traction to get serious interest from angel investors. So how do you fund your startup before you're angel ready in order to get you angel ready? In this video, we'll cover 10 different ways that you can do exactly that. Hi, I'm Steve Morris, and I use this Startup SOS channel to provide practical how-to advice for first-time entrepreneurs. So it's true. Angel investors typically will not fund an idea. You typically have to have made some headway. And in a future video, we'll kind of walk through a roadmap as to what that headway might look like to get you investor ready. But today we'll focus on, okay, you need to make headway. You need some funding to do that. How do you do that when you're not angel ready? You don't have access to traditional angel investors. Well, we'll walk down a list of 10 different ways to fund your startup early on. Well, certainly the old standby for funding a startup is savings and debt, credit cards, second mortgages, and so forth. And many startups got funded that way. You have to be a little careful, clearly, with savings and debt. It's maybe not a great idea to use up all of your retirement savings, especially as you get older. And it's not a great idea to go deeply in debt when you're funding a startup that, let's face it, has a fair amount of risk involved. But having said that, the reality is a lot of startups got funded this way through a combination of savings and debt. So it's certainly a viable approach for very early stage funding of your startup. Another very common approach is to keep your day job, to get paid for doing what you do in the day, and then evenings and weekends, you work on your startup as a side project. Clearly that has the disadvantage that it slows you down. You're not going to make headway as fast on the one hand. On the other hand, you have income. You can pay the rent and buy food and do all those things that you need to do. So sometimes that's just something that an entrepreneur has to do is keep the startup as a side project for at least a while. One thing to be careful about is to check with your employment agreement to make sure that anything you're developing on the side actually does belong to you. The intellectual property of it belongs to you. There are some employee agreements that get pretty aggressive in terms of saying any idea you come up with while you work for us, we own. And you want to make sure that you understand exactly what kind of an intellectual property assignment arrangement your employment agreement might have. Of course, the other thing to be careful about is when you're working on your startup, another thing to do to make sure that you own it is to not use any of your employer's resources. Certainly no proprietary information, but even things like computers and information services and so forth. You really want to keep what you're doing completely separate from your employer's resources. And if you have any doubts about any of that, of course, consult an attorney to make sure that your intellectual property is clearly owned by you. Another option is what I call spouse-based funding. If you have a spouse or significant other and you can manage to live on one income, well, then while your spouse is earning some money to pay the bills each month, you have the option then of being able to work full-time on your company. That clearly only goes so far. That doesn't really help you fund out-of-pocket expenses, capital investments, and so forth. But at least if you can live on one income as a couple, it gives you a very long runway to work on a company, again, without having to have an income. So that can be another very practical way to fund your early stage work on your startup. Of course, friends and family funding is another very common source of funding for an early stage startup, because the people who are more likely to invest in your idea are the people you're either related to or the people you know. You have to be careful to set expectations with friends and family that this is a risky investment, and you need to make sure that they don't invest more than they could afford to lose. If things don't go well, you still want friends and family to be friends and family by the time you're on the other side of the startup. So setting expectations is important. And you do need to comply with the securities laws also. So it's important to make sure you work with an attorney and do your fundraising within one of the SEC exemptions. And as we've talked about in other videos, that's certainly possible to do even if friends and family are not accredited investors. Work with an attorney, make sure you take the money from friends and family in an appropriate way. Another great source of funding for a startup can be customers. Let's say you're in a business-to-business situation. You have a very strong team, you're developing a product, and there are customers you're talking to that really are interested in getting a hold of the product. Well, sometimes you can actually negotiate a special deal, maybe it's with one particular large, very interested customer, where you negotiate getting a prepayment from them in return for maybe them having particular input into the feature set for the product. Maybe they get the product earlier than anybody else. That can be attractive to a company as long as they have confidence that your team can actually deliver on the product and it's a product that they really, really want. Well, that's a nice way to get some early funding. It's not dilutive, it's revenue. So you're not selling a portion of the company, you're not taking on debt even, you're actually getting early revenue, which is great. Now, one thing to be careful about in doing deals like that is you'd like to be sure that at the end of this arrangement, you walk away with ownership of the intellectual property, the IP for the product. So that's the trick, is in negotiating this deal, they get early access, they get input, they get the product when it's done, but you retain the intellectual property rights to the product so that you can go ahead and continue development and then actually roll it out into the market to provide it to other customers. But this can be a great way to fund a company with early revenue. Another great source of funding for any kind of a technology company can be government grants. Now, when I say technology, I mean anything from a software company to maybe a company developing some kind of device or instrument, some kind of a chemistry-based product, whatever it is, but it's science or technology-based. It's worth looking into the government grant programs. And specifically, I'm talking about the SBIR, Small Business Innovation Research, and STTR, Small Business Technology Transfer Research. These programs provide more than $3 billion in non-dilutive funding for startups every year. They're either in the form of a grant or in form of a contract, but either way, it's non-dilutive funding. And what's great about these programs is that they will fund development. Development can be a tough thing to get angel investors to fund because development stage is very early. It's very risky. It's what these particular grant programs were designed to fund. So any kind of technology company, this is something you definitely should look into. Check out the series that we have on the SBIR and STTR programs. Put a link to that right up in the corner so you can check those out. Then, of course, there's traditional crowdfunding, a la Kickstarter and platforms like that. The interesting thing about crowdfunding is you're sort of doing two things at once. On the one hand, you're getting customer validation of your idea because you're actually getting customers to pay you before you even really have a product ready to ship. That's a very sincere form of validation of your idea. On the other hand, you're also getting funding. They're sending you money. So you get validation, you get funding, all wrapped up into one. It's not easy. It does take a lot of work to have a successful crowdfunding campaign, a lot of work up front. You'll see that the successful ones are the campaigns where they really have established a fair amount of demand before they even officially open the crowdfunding process, so that very quickly they get some initial orders that shows traction, shows momentum, shows interest, and greatly increases the odds that you'll have a successful raise. But that involves a lot of work, a lot of marketing, getting ready for the crowdfunding, and then, of course, some pretty intensive continued marketing through the crowdfunding process. So definitely a lot of work, but it can be certainly a very viable form of funding. One thing to be careful of course, in crowdfunding is you'll frequently be providing the product to customers in a crowdfunding campaign. It's important, of course, that you understand the costing of your product. What you don't want to do is get a huge number of orders through a crowdfunding campaign and then discover, once you're finally ready to manufacture it, that it costs you more to make each product than what you're charging customers. That can be a huge problem, can get you into trouble with the government, and obviously in hot water with customers who you've made a commitment to. So be careful to make sure you understand your product costing and how much it'll actually cost you to make it, so that you're sure that you at least won't lose money each time you deliver a product to a customer. Option number 8, regulation crowdfunding. So this would be the federal government version of crowdfunding for equity. We talked about this in our program on SEC exemptions, reviewed some of the basics of how this can work. Real briefly, the idea is that you have to work with a third party who's registered to do this kind of offering, and they will do the soliciting and the actual sale of your security for you. The thing to know about this option is it does take some time, and it takes some money. You'll have to pay your platform partner. It takes some preparation. There's some disclosures you have to do, and you have to post a notification to the government that you're doing this crowdfunding process. So it's not easy, it's not free, and it's not risk-free either, but it does allow you to raise money early on from both accredited and non-accredited investors. And with a little luck, your regulation crowdfunding partner, the platform you're working with, the company that's doing the posting of your offer and the collection of the money, they hopefully can help you market it. So it has some pluses too. Certainly it's another approach that can be available to you before you're ready for traditional angel investors. Another option is intra-state crowdfunding. This is a situation where your state takes advantage of an exemption the SEC provides under what they call Rule 147 or Rule 147A that allows you to raise money specifically in one state from people in one state only. And in that case, it's really the state that's making up most of the rules. Now, we talked about some of the guidelines for this in our video on raising money from non-accredited investors. I'll put a link to that up here so you can check that out. Like the federal version, it takes time and some expense to do this, and in this case you are limited to just one state. But if you think you can raise the money that you need for your company from investors in your state, this can certainly be a viable option if your state is one of the 35 or so states that's taken advantage of this exemption and offered a program to startups for raising money in this kind of a state-specific way. So you'll have to do a little research and check out what is offered by your particular state and what the rules are for your state, because each state has a different set of rules. And finally, one more category, seed funds and accelerators, another source of funding that you may have access to before you're really ready for traditional angel investors. The trick with both seed funds and accelerators is they're very competitive, so this can be a tough one to tap into. But on the other hand, they can be attractive in that they come with typically not just money, but also with assistance, with mentoring, with introductions, with meeting investors and meeting other entrepreneurs who can sometimes help. So it's another option to look into. This does tend to be an investment option that involves some dilution, but that's something you have to get used to when you're funding a startup, is when you get investment, you tend to get some dilution that comes along with it. There are a broad range of seed funds, ranging from the really well-known like Y Combinator and Techstars that invest some fair amount of money if you get in, to smaller local seed funds that might invest quite a bit less, might be easier to get into with less competition. So another category to look into for funding your startup before you're ready for angels. So there's 10 different ways to fund the early stage work in your startup before you're ready to go get angel investing, which would typically be kind of the next stage of funding for a growth company. Now, the question is, which of these is a fit for where you are, what kind of funding you need, and what you need to accomplish in order to get investor ready. But at least it gives you a starter list of things to think about to get the funding you need to move your startup ahead to get to that next stage of funding. If this was helpful, please click the like and share it with other entrepreneurs. And if you have any comments or questions, please leave a comment. If you haven't subscribed yet, please do that. Click that notification bell because there's more coming up, and there's a link to a playlist right below me where we'll keep adding new videos in this series on funding your early stage startup. That's a wrap for how to fund your startup before you're angel ready. Thank you very much for watching.